Hey everyone, Larry Bailey here with another weekly newsletter update. Today is May 28th, and we are going to review May 20th in review. This information is brought to you from MBS Highway, your trusted source for mortgage market intelligence. Always get over to mbshighway.com if you want to see what's going on. Today's 10-year Treasury is more expensive by 4 basis points, and the price is lower on the bond trading. So there's a lot of information coming out. We're going to get into last week's review and then also what to expect for this week. So pay attention. If you ever want to see this video so you can see everything that's on screen, head over to mortgage.community for the whole video and the whole replay. To those that are listening on podcast replay, thank you. Hopefully I keep my voice in such a way that you want to continue to listen to it. So here's last week in review, May 20th, 2024. The pace of home sales declined in April, though the speed at which existing homes sold accelerated, plus a parade of Fed speakers and the minutes from last meeting shed light on their views about inflation, the labor market, rate cuts, and more. Here's the headlines we're going to go through. The first story is existing homes selling fast. Next story is new home sales slip in April. Next story is the full week of Fed chatter. There you go. So, last story is initial jobless claims declined during key data week. Here we go in the first story. This is all about existing homes selling fast, and we see an image on here, sources from the National Association of Realtors. So sales of existing homes fell 1.9% in April to a 4.14 million unit annualized pace per the National Association of Realtors, NAR. Those sales in March were revised higher, and this offset some of the decline. This report measures the closings on existing homes in April and likely reflects people shopping for homes in February and March. Bottom line from this story, of course, is while the pace of sales declined in April, the speed at which homes sold accelerated. So homes remained on the market for a shorter period of time in April, with just 26 days average, down from 33 days in March, plus 27% of homes sold above list price. These factors both signal that the demand and competition remain during the spring buying season, even in the face of elevated interest rates. Inventory also saw a boost, as 1.21 million homes available at the end of April were up 9% from March and a whopping 16.3% from a year earlier. And while this remains below healthy levels at just 3.5 months supply at the current sales pace, rising inventory is certainly a step in the right direction to help improve ongoing tight supply. We'll see. We'll see how that continues. This next story is about new home sales slip in April. So there's a graphic on here from the U.S. Census Bureau and from HUD. New home sales, which measures signed contracts on new homes, fell 4.7% from March to April, missing the forecast that were expected, where they expected them to rise. Signed contracts were also 7.7% lower than they were in April of last year. So this one is an interesting one. This report measures buyers who were shopping for homes last month when rates peaked. So the pullback is understandable as some buyers chose to delay their home search. I'll tell you this, some home buyers probably were knocked out of the market because of interest rates. However, demand for new construction remains strong due to the persistent shortage of existing homes for sale. On that note, more, quote, available, close quote, supply is needed to meet buyer demand. Yeah, we know that. We've been talking about this like forever. While there were 480,000 new homes available for sale at the end of April, slightly higher than the 470,000 seen in the previous report, only 98,000 of those 480,000 homes were actually completed. And the rest of them are either under construction or not even started yet. So the median home price fell 1.4% from March, but this is not due to falling home prices. In fact, the home prices continue to rise nationwide per the Case-Shiller and other appreciation indices. The median home price, remember, represents the mid-price of sales, meaning it's influenced by both the mix of sales on very expensive and not so expensive. Builders are constructing smaller, more affordable homes to meet buyer demand, and that pushed the median home price lower comparatively, which hopefully smaller homes, less expensive, more stock, more buyers. We'll see. We'll see how this plays out. Here we go into the full week of Fed chatter. Yeah, if you're not ready for Fed to hear the Fed everywhere, like I literally was listening to an NPR report over the weekend, and they actually talked about personal consumption expenditures, and I'm like, what is going on? So here's the story. The minutes from the Fed's April 30 to May 1st meeting were released last week, which showed that the members had growing concerns about inflation. Listen, this wasn't a surprise given the meeting followed a string of reports showing inflation was more persistent than expected in the first quarter of this year. Since the Fed met, reports have shown cooler inflation as well as slower job growth, a rising unemployment rate, and flat retail sales. Last week also brought a parade of Fed speakers that included notable comments from Fed Governor Christopher Waller, who echoed several of his colleagues when he said, quote, "In the absence of a significant weakening in the labor market, I need to see several more months of good inflation data before I would be comfortable supporting an easing of the stance of monetary policy," close quote. In English, months, the takeaway, I want to see months, several months of good inflation data before I would be comfortable supporting a lowering of interest rates. That's what he said. So several months. It's May. It's June. This week is June, for goodness sake. So does that mean we're going to get a rate cut this year? Who knows? An easing of monetary policy would bring us cuts to the Fed's benchmark Fed funds rate, which is the overnight borrowing rate for banks, not to be confused with mortgage rates, gang. Remember that. Fed funds rate is not the same as mortgage interest rates. So here's the bottom line of the story with the Feds. Remember, the Fed has been working hard to tame inflation, and it hiked its Fed funds rate 11 times between March of 22 and July of 23. Remember, these hikes were designed to slow the economy by making borrowing more expensive so the demand for goods would be lowered, thereby, in theory, reducing pricing pressure and inflation. While inflation was making good progress lower late last year, readings about the first quarter this year were unexpectedly high, causing the Fed to hold Fed funds rate steady as they take a more patient approach to rate cuts than initially thought. However, Waller's comments suggest a sharp rise in unemployment rate, which has been given a narrow range between 3.7 and 3.9% since August. That could also impact the timing for rate cuts. Remember, because the Fed has two jobs. First is price stability. The second is maximum employment. So that brings us right into the next story of initial jobless claims declined during key data week. So the number of people filing for new unemployment claims declined by 8,000, with 215,000 initial jobless claims reported in the latest week. This followed a decline of 9,000 in the previous week, marking the biggest back-to-back drop since September. Continuing claims rose by 8,000, with 1.794 million people still receiving benefits after filing their initial claim. Bottom line here is initial jobless claims came in below estimates, while continuing claims are also still trending near some of the hottest levels we've seen in recent years. The dynamic we've been seeing in the labor sector continues, where employers are trying to hold on to their workers, but once people are let go, it's more challenging for those people to find new employment. Note this was an important real-time report because it includes the sample week that the Bureau of Labor Statistics, the BLS, will use in the modeling for their job growth estimates in the May jobs report. While this is just one component of that report, the low reading of 215,000, that initial unemployment claims, that could point to strong growth when May's report is released for June 7th, which could be a problem if the Fed's looking for higher unemployment. So the Fed's going to be closely analyzing this report for signs of labor sector softening as it weighs the timing for rate cuts this year. It's a dance, gang. It's a dance. So try to keep up. If you're listening to this on podcast and you're interested in celebrating the National Scone Day on May 30th, head over to mortgage.community, check out the recipe that you see on the screen here during this part of the recording, and learn all about it. This one is all about these current scones from Martha Stewart. There you go. Here's what we're looking for this week in the report. So more housing reports are ahead for starting Tuesday. That's tomorrow, with appreciation data from March and from Case-Shiller and the Federal Housing Finance Agency, also known as FHFA. April's pending home sales follow on Thursday. Also on Thursday, look for the second reading for the first quarter GDP and the latest jobless claims. Friday, it's all about the Fed. So this brings the most crucial report from the Fed's favored measure of inflation, personal consumption expenditures, PCE. Again, it's on general news, so people are learning all about economics, which I guess I love. My name is Larry Bailey. Thank you very much for always listening, and that is our wrap for the week of May 20th. Take care.